The volatility index is a financial metric used to measure overall volatility or fear that is currently permeating through markets. A lower VIX reading indicates low volatility and normally coincides with market rallies. Conversely, a high VIX reading indicates increased fear in markets and normally coincides with market contractions. The VIX reached one of its highest points in recent years on Tuesday, April 8, 2025, in the aftermath of the Liberation Day tariffs. It was in fact one of the highest readings outside the big two events, global financial crisis and the COVID-19 pandemic, which saw unprecedented levels of volatility. So the question is, what tends to happen to markets after the VIX hits a high point? In this chart here, we've excluded the big two events and instead focus on other significant periods of volatility over the past 35 years. From these spikes, we measured the subsequent 12-month performance of the S&P 500. Having already discussed the April 8 spike and its current 31% return, we now turn to other notable periods. August 2011. The VIX reached 48 on Monday, the 8th of August 2011, following S&P's historic downgrade of the US long-term credit rating, the first in history. The reaction was severe, with the S&P 500 dropping over 6% in its worst day since late 2008, and fears of a double-dip recession emerged. Yet by 8th of August 2012, the S&P had gained 25% over the prior 12 months. On Thursday, 20th of May 2010, the VIX spiked to 45 amid Eurozone sovereign debt fears, sharp equity sell-offs, and contagion concerns. The Greek debt crisis was at its peak, with the worries about potential contagion to Spain, Portugal, and Italy. Nevertheless, 12 months later, the S&P had recorded a gain of 24%. August 2002, US markets were still reeling from major corporate bankruptcies, including Enron, Global Crossing, and later WorldCom, then the largest bankruptcy filing in US history. The S&P 500 reached a 5-year low on the 5th of August 2002, bottoming out only weeks later in October. 1 year on, the index had gained 18%. October 1998, the VIX peaked at 45 on Thursday, 8th of October 1998, as markets reacted to Russia's domestic debt default and the collapse of long-term capital management area that summer. The S&P fell 3% in the day, reaching its lowest level in a year. Yet by October 1999, it had gained 39%. In conclusion, while each volatility spike was triggered by different factors, the outcome has consistently been the same: subsequent equity market growth. These episodes reinforce the importance of discipline during turbulent periods. As demonstrated by April's spike, such moments often present opportunities for long-term investors. Considering that we are just a few months removed from the most recent volatility surge, it could be argued that the current equity rally still has significant room to run. After all, records are there to be broken. For more insights such as these, please visit our website www.cspareprivate.ie.